Welcome back to our channel where we discuss all things finance and investment. Today, we're diving into a topic that's on many minds: how to profit during a recession. In uncertain economic times, there are strategies that can turn challenges into opportunities. I'm here to guide you through 5 ways to invest wisely during an economic downturn. But before we get started, if you haven't already, hit that subscribe button and ring the notification bell so you never miss out on our future investment insights. Let's begin with the first way to navigate a recession: diversification. Let's delve deeper into the rationale behind diversification during economic downturns. When markets face turbulence, certain assets often perform inversely to others. For instance, while stocks might plunge during a recession, safe haven assets like gold, often considered a hedge against inflation, tend to retain or increase in value. Bonds, particularly government bonds, can provide a stable source of income as they're seen as a safer investment during uncertain times. However, diversification isn't just about spreading investments across various asset classes. It's also about considering geographical diversification. A recession might hit some economies harder than others. Therefore, investing in international markets or global funds can add a layer of protection. Emerging markets might suffer less from a recession impacting developed nations, or might recover more quickly due to different growth factors. Moreover, when it comes to defensive stocks, companies that provide essential goods or services that people need regardless of the economic climate, like healthcare or consumer staples, often remain more stable during a recession. Diversification isn't just a strategy, it's a mindset that emphasizes risk management and the recognition that no single investment will perform the best in all scenarios. By spreading your investments across various sectors, regions, and asset classes, you're better positioned to weather the storm of a recession and even find opportunities for growth amidst the chaos. Number 2, value investing. Value investing, as famously advocated by Warren Buffett, is a timeless strategy that gains particular relevance during a recession. The core principle involves seeking out stocks that are trading below their intrinsic value, often due to market overreactions or temporary economic setbacks. When an economic downturn occurs, fear and uncertainty can lead to broad market declines, causing even fundamentally strong companies to experience significant drops in their stock prices. During such times, the market tends to amplify negative sentiments, undervaluing businesses that might have a solid financial foundation, robust management, and competitive advantages. Identifying these undervalued stocks during a recession presents a significant opportunity for investors. These undervalued companies, often referred to as diamonds in the rough, have the potential to provide substantial gains once the market corrects itself and the economy begins to recover. However, value investing demands patience and a long-term perspective. It's not about quick wins, but rather focusing on the underlying value of a company. Buffett's philosophy underscores the importance of extensive research, understanding a company's fundamentals, and investing in businesses with sustainable competitive advantages, sound management, and durable business models. Moreover, during a recession, the markets might not fully appreciate a company's future growth potential, creating an ideal environment for value investors to acquire these stocks at discounted prices. This approach isn't about timing the market, but rather identifying solid companies at attractive prices with the confidence that their value will be recognized over the long term. Value investing, while not immune to market fluctuations, can provide an effective strategy to navigate the choppy waters of a recession and position investors for significant gains as the economy stabilizes and rebounds. Number 3, dividend investing. Dividend investing, especially during a recession, offers a strategic approach that emphasizes both income generation and long-term wealth accumulation. When the economy faces uncertainties and market volatility, companies that consistently pay dividends signal stability and resilience in weathering economic storms. These dividends can be a crucial source of income for investors, offering a degree of financial security during turbulent market conditions. Reinvesting these dividends can significantly bolster an investor's overall returns. The power of compounding allows these reinvested dividends to generate additional shares of stock, thereby creating a snowball effect of wealth accumulation. Over time, this compounding effect can substantially boost the total return on an investment, contributing to a significant portion of an investor's portfolio growth. Moreover, dividend-paying stocks often belong to mature, well-established companies that have a history of solid performance and a commitment to rewarding their shareholders. During a recession, such companies may display more stability compared to high-growth stocks, which might be more volatile or susceptible to economic downturns. Dividend investing isn't solely about the immediate income, but also about building a resilient and growing portfolio. The ability of certain companies to consistently pay dividends, and even potentially increase them over time, demonstrates financial strength and management's confidence in the company's future prospects. However, it's important for investors to conduct thorough research on dividend-paying companies, evaluating their payout ratios, history of consistent payments, and their ability to sustain dividends even during challenging economic times. By selecting companies with a proven track record of dividend payments and a strong financial position, investors can potentially secure both income and capital appreciation even during recessions. Number 4, real estate investment. Real estate investment during a recession can indeed offer lucrative prospects. When the broader financial markets face volatility, real estate often stands out as a tangible and relatively stable asset. While real estate markets may experience a temporary decline, this dip can unveil unique opportunities for savvy investors. Investing in real estate during a recession can take various forms. One avenue is acquiring undervalued properties, capitalizing on the market's downturn. Such investments have the potential to yield significant returns when the real estate market recovers, as historically, property values tend to appreciate over the long term. Rental properties also offer a compelling strategy. During economic downturns, some individuals might opt for renting over buying, leading to increased demand for rental accommodations. This increased demand can provide consistent income streams for investors, contributing to financial stability even during recessionary periods. Furthermore, the cyclical nature of real estate suggests that the market often rebounds after a downturn, potentially presenting investors with substantial capital gains. The real estate sector, while not immune to economic fluctuations, has shown resilience over time and has served as a reliable investment option for wealth creation and portfolio diversification. However, real estate investment demands thorough due diligence. Understanding market trends, location analysis, and ensuring the ability to sustain the property during lean times is crucial. Additionally, having adequate capital reserves to weather market uncertainties and potential maintenance costs is vital for successful real estate investing during economic downturns. In summary, while real estate can face short-term challenges during a recession, it remains an attractive investment avenue due to its potential for long-term appreciation, income generation through rentals, and its historical track record as a wealth-building asset. Smart investments in real estate during economic downturns can be a cornerstone of a well-diversified portfolio. Absolutely, real estate can be a game changer. Number 5, the power of cash. The power of cash reserves during a recession cannot be overstated. Holding cash during economic downturns provides a significant advantage, offering investors the flexibility and liquidity to pounce on opportunities that arise when financial markets are under stress. During a recession, asset prices often plummet, creating a buyer's market for astute investors. Those with cash on hand can capitalize on undervalued assets, whether it's stocks, real estate, or businesses, as distressed sellers might be more willing to negotiate lower prices. Having cash enables investors to act swiftly and take advantage of these discounted assets, potentially leading to significant returns when the economy rebounds. Moreover, cash reserves act as a safety net during volatile times. They provide a buffer against unexpected financial emergencies, job losses, or unanticipated expenses, shielding investors from having to liquidate other investments at unfavorable prices. Maintaining a cash position during a recession also offers peace of mind. It can alleviate the stress of being over-leveraged or having to sell investments at a loss to cover expenses, ensuring a more stable financial position during uncertain economic climates. However, the strategic deployment of cash is crucial. Investors must strike a balance between holding adequate cash reserves and ensuring that the cash doesn't sit idle for too long, potentially losing value due to inflation. It's a delicate balance between liquidity and maximizing the potential returns from investment opportunities that emerge during a recession. In essence, having cash during a recession is akin to holding a strategic weapon. It provides investors with the means to seize opportunities that others might not be able to afford, navigate financial uncertainties, and ultimately emerge stronger when the economic tides turn. Maintaining a healthy cash reserve is a prudent strategy that allows investors to be proactive rather than reactive in the face of economic challenges. Remember, a recession isn't just a time of uncertainty, it's also a time of potential. By applying these strategies and staying informed, you can position yourself to not just weather the storm, but to thrive during economic downturns.